Hi everyone, hope you all must be doing great and welcome to this channel. Now this channel is dedicated only for English classes. My Hindi classes will be uploaded in my last channel, and this is only for especially for my South Indian students. Okay, so today we are starting with this chapter, Deductions from GTI chapter 6A from section 80C to 80U. And students who are new to this channel, if they would like to refer to the previous videos of English related to our 5 heads of income or set off or carry forward, then they can refer, because these videos were already uploaded in my earlier channel. So you can refer those videos from that channel. I'll give you the link also in the description, right? So today we are starting with deductions from GTI. It's a very important chapter and also very easy as well, right? So we have sections starting from section 80C to 80U, which comes under this chapter, deductions from GTI. And I tell you that basically this chapter is for those individual in HUF who are opting for optional tax regime. Because if the assessee is opting for new tax regime, that is default tax regime, in that case, only very few sections, only 3 sections are there which are applicable for new tax regime. Otherwise, all the sections are not for new one. They are only for the person who are opting for optional tax regime. I'll tell you, there are only 3 sections: 80 CCD 2, 80 CCH 2, and 80 CCH is a new section. I'll tell you that also, and 80 JJAA. These only sections, these 3 sections are only applicable for new tax regime. That is optional tax regime. Assessee also can claim these deductions. But if the assessee is following default tax regime, he or she can claim the deductions only from this particular sections, right? Not for other sections. So if you look into this book, and I hope that you have this handwritten book with you. If you don't have it, you can download it. The PDF version is available on our website, rajatmoga.com. Again, I'll give the link in the description also. You can download this. It is available it's a beautifully crafted book available in a PDF format. You can go and easily download it. And if you wish, I would highly recommend get the photostat copy of it also, right? Okay. So we are starting with this chapter, section 80C to 80U. See, I have divided this chapter into 3 parts, right? So first of all, we have 80, although the section will start from 80C and it will go till 80U, right? But this 80C to 80U, I have divided it into 3 parts. One is 80C and 80G to 80G. Other is from 80IA to 80 RRB. And the third is the other sections, 80 TTA, TTB and 80U. And what is the basis of this categorization is that sections starting from 80C to 80G are available only when we make certain expenses or we make certain investments. Then only we can claim deductions from 80C to 80U. Sorry, 80C to 80G. Assessee has to make a payment to someone, or assessee has to invest the money somewhere. That is, in this case, I can say, to summarize it, I can say that you have to make a cash outflow. You have to make a outflow. Then only you can claim these deductions. So 80C to 80G are deductions in respect of certain payment. Whenever you will be making certain payments, then only you can claim deductions, right? Whereas these sections 80IA to 80 RRB. Now you will tell me, sir, we haven't heard about anything about 80 IA, IB, IC and all. Actually, these are sections in this chapter 80C to 80U, but they are not in our syllabus. We will deal mostly with these sections 80I, I series, 80P, 80J, etc. These are covered in our CA final level. So in this particular category, we have only 2 or 3 sections, which is in our CA intermediate course. One is 80 JJAA. Other one is 80 QQB and 80 RRB. You remember that royalty sections 80 QQB and 80 RRB is there. So in this particular category, although it is starts from 80 IA to 80 RRB, but in our syllabus in intermediate, we have only 3 sections. But this category is related to, here we don't have to make certain payments. Here we were making certain payments. In this, if we are coming in this category, then we have to make certain cash outflow, then only we can claim deductions. But here in this, if we have business of such nature, if we have business of such a nature which these sections suggests, then we can claim deductions. So these are business linked deductions. If you are running the business of such a nature, such a kind, then only you can claim deductions. So here some businesses are mentioned over there. So I can say that these are profit linked deductions. If you have profits from such business, then you can claim deductions. Got it? So these are deductions in respect of certain income. But I tell you, in CA final, we do all these sections. But in intermediate, we have only 2 or 3 sections: ATJJAA, QQB, and ATRRB. And this third category is other deductions. This is other deductions. Here, you don't have to make any payment. You don't have to do certain business. But here, you can claim some deductions. So this is in third category: AT, TTA, TTB, and ATU. You understand TTA, TTB is for if we are getting interest income. TTA is from saving, TTA is from saving bank account. TTB is for senior citizen. I will also make you revise it. And ATU is related to if the assessee is disabled. If the assessee himself or herself is disabled, then they can claim deductions under ATU, right? So we will discuss these sections today. And I have also mentioned a note over here that these sections are mainly if the assessee is opting optional tax regime, then there is no problem. He can claim deductions from all these sections, right? But if the assessee is claiming, is coming under, is following default tax regime, that is new tax regime, then only 3 sections are there. Please remember this. This is something which is very important. 80 CCD2, that is related to pension scheme. We have in 80 CCD, we have some parts. We have 80 CCD1 also. We have 80 CCD1B also. Do you remember? In 80 CCD, I can make it, I can segregate into 3 parts. We have 80 CCD1 also. Then we have 80 CCD1B also. Don't worry if you don't remember these sections. I'll make you revise also. And we have 80 CCD2. See, if the assessee is following old tax regime, optional, then that person can claim deductions from all these 3 subsections, right? But in case the assessee is following new tax regime, default tax regime, then only this section is available. That person cannot claim deductions under these 2 sections. Only this sections he can claim deduction, right? So we have 80 CCD2. In 80 CCH, again, we have 2 sections, 80 CCH1, 80 CCH2. This is a new section which has been introduced. This is an amendment. So I believe that for 2024 examinations, this can come in your examinations, right? So in 80 CCH, this is related to Agnipath, the people who are joining armed forces for 4 years. So this is a scheme which is floated by the Indian government. So they are saying that here we have 2 deductions, 80 CCH and 80 CCH1, 80 CCH2. So only if the assessee is following new tax regime, only 80 CCH2 is available. I'll make you revise that also. And we have old section 80 JJAA for new workmen. If you are employing, if you are an assessee who are required to get your accounts audited and you give employment to new workmen, then 80 JJAA is available. I'll make you revise that as well, right? But I am emphasizing on these 3 sections because you have to remember that if the assessee is following new tax regime, please do not give any deductions from these sections. Only these sections are allowed for new one, right? Okay. And I would also like to emphasize on the point that we are doing chapter 6A, 80C to 80U. So this is called deductions which are allowed, right? And these deductions are allowed only from our normal income. If the assessee is earning special income also, assessee is earning special income, like assessee is having LTCG or 111A income, STCG on equity shares or equity oriented units, or assessee is having 112A income of long term equity shares, equity oriented units again, or the assessee is having any casual income, then assessee cannot claim deductions from those sections, from those income, right? Assessee can claim deductions under chapter 6A only from normal income. See, let's say if the GTI of the assessee is, let's say rupees 12 lakh. GTI means all 5 heads income plus clubbing and set off. After that, we get GTI. So let's say the GTI of the assessee is 12 lakh, right? So first of all, please understand that in chapter 6A, if we would like to claim a deduction of chapter 6A, then we cannot go more than 12 lakh. If you are claiming deductions under 80C, 80 triple C, 80CCD, 80D, 80, any of the section of chapter 6A, then we cannot go above 12 lakh. Let's say if the total of all these sections are coming 13 lakh, no, we cannot go over and above GTI. First thing first, you cannot go over and above GTI. Second thing is that you cannot even claim deductions from your special income. So what we have to see is whenever you are giving deductions of 80C to 80U, I would recommend please do a rough work. Please do a rough work first. At the backside of your question of your answer sheet, you can do a rough work where while submitting your answer sheet to the examiner, you can cut that page. That is at the backside of your answer sheet, the last page. Just do a quick rough work. So whatever is the GTI of the assessee, first of all, please segregate them into special income. Do we have any special income? First special income is long-term capital gain, normal long-term capital gain. Second is 11111A, that is short-term capital gain. Do you remember that? So all these points we have already discussed in our capital gain revision. Okay. And if we have income from 112A, that is LTCG on equity shares. This was normal LTCG of 112, and this is LTCG of 112A. And if we have any casual income or undisclosed income, and then we have remaining income. This remaining income, right? So we can claim. So let's say if the assessee is having, let's say I'm giving some figure also over here. Let's say if assessee is having 2 lakh rupees LTCG, 1 lakh rupees 111A. Let's say 112A assessee doesn't have casual income, let's say 3 lakh. So see, how much is the remaining income now? Out of 12, we already have 2, 1, 0, 3. Okay, let me keep something in this one also. Let's say it is 2 lakh over here. So we have special income, how much? 2 plus 1, 3, 2, 5 and 8. We have 8 lakh rupees as special income, right? So now our remaining income is just from 12, just subtract all these things. We have 4 lakh rupees as our remaining income. So guys, please understand that you cannot claim deductions from these normal income. Maximum deductions which you can claim is 4 lakh. So chapter 6 say overall deductions from 80C to 80U. If I aggregate all the sections which assessee is claiming, that person cannot claim more than 4 lakh, right? So this is something which is very important. It comes in your MCQs also. That examiner will ask you that this is the amount he has in total income, and so is a special income. So he will not say special income, he will give it a name. Let's say 112 LTCG, or he will say 112A, that LTCG of equity shares or casual income. So please subtract all these special income, or even if it is undisclosed income, that is unexplained cash credit or unexplained money, that is also special income. Please deduct that. So whatever is the remaining income, you can claim deduction of chapter 6A only from this income. I believe that you have understood this. Correct? Okay. Okay. You can ask me a question. Sir, in 112A, we understand that we have to pay tax at a rate of 10%. Sir, but that tax is in excess of 1 lakh rupees. So here 10% will be on in excess of 1 lakh. It is, we will deduct 1 lakh from it, and only on remaining 1 lakh we will claim 10% deduction. So our 112A is 1 lakh or 2 lakh? No, it is 2 lakh. That is only for the purpose of calculating tax. You deduct 1 lakh rupees, right? So, but here you will take it as 2 lakh. So in 112A, you have income of 2 lakh. That is part of a total income. This is only for the purpose of calculating your tax. We give that 1 lakh rupees deduction, right? So here, while calculating this amount also, please take it, whatever is 112A, here it is 2 lakh, please take it 2 lakh. Got it? Okay. So this is written over here. See, you don't have to remember this section 80A, but you should know what it is written over here. This section states that while computing total income, deductions from 80C to 80U are available. 80C to 80U are available. You can claim deductions. However, such deductions cannot be more than GTI. We understood that. However, that deduction cannot be more than GTI. And now we know one more point. Even we have stepped down to one more detail that not even GTI, it should not be more than our remaining income, right? So this is already mentioned over here. Chapter 6 reduction is allowed only from normal income. Please underline this, only from normal income. You can claim deductions only from normal income. You cannot claim deductions from these special income. Got it? And it says 80I to 80 RRB. This about this category it is saying. Actually, this category is known as in chapter 6A. In chapter 6A, if we read the Bear Act, so it is covered under heading C. It is covered. You don't have to remember this. You just have to just acknowledge this thing, right? This is just for your knowledge purpose. In chapter 6A, we have heading C. In heading C, this is given by Income Tax Act. So this 80IA to 80 RRB, 80IA to 80 RRB comes under heading C. So this section says, because these are what? Please, it is very logical. These are what? These are profit linked deductions. If we are earning income from such type of business, then whatever the income is, we can claim deductions only from that profit, right? So let's say if in 80IA there is some kind of business is written over there. So let's say we have income of rupees 10 lakh from that particular profit from that business. We have income of 10 lakh rupees. So if you would like to claim a deduction of 80IA, can you go more than 10 lakh? No, it should be restricted to that income which is coming, right? So let's say in 80 QQB, that we understand, that is royalty on books. In 80 QQB, let's say the royalty earned by the assessee is rupees 2 lakh, right? He has earned rupees 2 lakh as royalty income. Can he claim deductions of more than 2 lakh? The answer is no, right? This is very logical because these are profit based deductions, these are income based deductions. So whatever the business or income in the nature of that income we are earning this particular thing, then we cannot claim deductions more than that, correct? So it is written over here, deductions under 80IA to 80 RRB cannot be more than the income of such eligible business, right? Whatever the income which we are getting from that business, it should not be more than that. So this was a basic background of chapter 6. I believe that you understood the basic background, although we have not started any of the sections from 80C to 80U as of now. So this was the basic background. I have explained you in detail so that your base should be strong, right? Now we'll do quickly. First section is 80C. First of all, tell me whether if the assessee is claiming, is following new tax regime, can he claim deductions under 80C? The answer is no, sir. We have done a rectification now. So in if the assessee is following new tax regime, only 80 CCD2 CCH2. Please repeat it with me. 80 CCD2, 80 CCH2 and 80 JJAA is available, right? Although I have written in this book that this section is 80C is only for optional scheme, but now you should know, right? You should know that this is not for new tax regime. Okay, 80C is related to certain investment. If the assessee is making certain investment and you also know that this category, first we are doing this category, right? 80C to 80G. So these are certain payments. Here assessee is making certain payments. Either he is making a certain expense, or he or she, he here means he or she, that person is making certain investments. So on and all, if I give you a summary, then the person is making a cash outflow. Then only that person can claim deductions of 80C. In 80C, we have a list of some 19-20 types of payments. If assessee is making payment to that particular in that particular places, then assessee can claim deductions. And one of the most important thing is that in 80C, we cannot claim more than 1,50,000 deductions. The maximum deduction which we can claim in 80C is 1,50,000. Even if you remember this also, we have section right now, we are doing section 80C. And with after a couple of minutes, we will do section 80CCC. And after that, we have section 80CCD And I have just told you that 80 CCD has three parts: CCD1, CCD1B, and CCD2. But right now, here only first part is included. So in 80 CCD1, the total deductions in these three sections, the total deductions cannot go more than 1,50,000. They cannot go 1,50,000. So the aggregate of all these three, 80C entire sections, we have some 18, 19, 20 in types of investments, we can make those investment. Total of 80C. 80 triple C is related to pension fund of LIC. I'll revise that also. 80 CCD1 is related to pension scheme. I'm not talking about 1B. So we have another section which we will do 80 CCD. See, this is also CCD, this is also CCD, but this is CCD1B. And there is another section in 80 CCD, 80 CCD2. These two sections are out of this limit. So 1,50,000 limit is only applicable to CCD1. Got it? Right. Okay. Coming back. So in 80C, I have written in the book that then 80C we can claim maximum deduction 1,50,000. In 80 triple C we can claim 150. In 80 CCD1 we can claim 150. But the total of this is it 4,50,000? No. The total of this is 1,50,000. Combined deductions we can claim is only 1.5 lakh. I believe you are getting this. It is only 1.5 lakh, right? Okay. So now, first of all, please understand who can claim deductions under 80C. Can a partnership firm can claim 80C? Company can claim 80C? The answer is no. Only individual and HUF. So 80C is applicable only to individual HUF. Sir, if the individual is non-resident, can he claim reduction of 80C? Yes. 80C is available. This is something which is important. Please remember this. 80C is available only to individual and HUF. Whether they are resident or they are non-resident doesn't matter. They can claim deduction under 80C. So only individual and HUF. AOPBY, no. Partnership firm company, no. Only individual and HUF, right? Okay. Maximum deduction I have already discussed, 150. So following are the eligible type investments. So I have given some 18, 19 points over here. Here you can make investments. In LIC premium, if you are paying, if the assessee is paying LIC premium, if the assessee is paying such type of investment. So there is a list on page number 10.3. If you come to page number 10.4, so there is a list. So up to this, I have divided it into 19 parts. So this, here the assessee can make investment. Here the assessee can make investment up to 1,50,000 can make. Right? Are you all getting this? Okay. First of all, this LIC premium is most important. This LIC premium is most important. You can mark it important also. So LIC is life insurance. Please remember, I am not talking about health insurance over here. I am only talking about the life insurance. If the assessee is paying their life insurance premium. So if the assessee is paying their life insurance premium, for whom he can pay the life insurance premium? For self, for spouse, and for children. Whether that children is a dependent child or a non-dependent child, irrelevant. I'm again repeating. If the assessee is an individual, then they can make the payment for self, spouse, children. Whether they are major, minor, dependent, non-dependent, okay. We are okay with it. It is allowed. So parents is not written over here? No. So here examiner will give you a tricky question. Examiner will say that assessee is making a payment for his father who is wholly dependent on him. LIC payment for he is making for his father. How much deduction? And you will say 80C, it is allowed. No. For father and mother, for parents, brother and sister, it is not allowed. Whether they are dependent also, then also please don't allow it. It is only and only for self, spouse and children. That's it. 80C is only for self, spouse and children. Parents are not included. Brothers and sisters, siblings are not included. Are you all getting this? Okay. So if individual is making the payment for these people, HUF assessee for any member of HUF, if they are making payment, deduction is allowed. But very important thing, sir, how much payment he has made? We know one of the limit is 1,50,000. But LIC has some internal limit also. LIC has some internal limit also. So it depends upon the date when this policy was taken, because these policies are very long-term policy, right? You understand? Whenever we get our life insurance done, it is for 10 years, 20 years, 15 years, and so. So it depends when was this LIC was started, when was this LIC was commenced in the year when we have taken this policy. So it depends upon when this policy was taken. And you remember, I have also discussed this in IFOS revision as well. So you have to remember this date, 1st of April 2012. If the policy is taken before this date means up till 31st of March 2012, right? Before this date. If the policy is taken before this date, then we understand 150 is the overall limit. But here the maximum which deduction which you can claim is 20% of sum assured. Whatever is the premium you are paying, if it is more than 20% of the sum assured, it is not allowed. Only up till 20% of your sum assured is allowed. What is sum assured? The total LIC which we have taken, the total amount which, if someone dies or in maturity, how much amount we will receive, that is called sum assured. So if the policy is before, on or before this date, 20% of sum assured. And if it is after this date, then it is on or after this date. This date is also included on that. On or after this date, then it will be 10% of sum assured. Whatever is the sum assured, we cannot claim a deduction of more than 10% of that. If the premium, let's say the sum assured is 12 lakh. And if the assessee is paying premium, see, in your examination, it is mentioned that assessee has paid premium of 1,40,000. You will say, sir, in 80C, we can allow 150. So, okay, sir, 140 is okay. We are not paying more than 150. 140 is allowed. But please, in LIC, there is one more internal limit. So, it depends on the date of the policy, when we have taken this policy. If it is before this date, 20% of sum assured. If it is after this date, 10% of sum assured. So, how much is the sum assured? Is 12 lakh rupees. 12 lakh is the amount of the policy. So 12 lakh into 10%, that is 1,20,000. So I understand this 140 is not going above 1,50,000 limit, which is the overall limit of ATC. But here we can claim maximum 1,20,000, right? Here we can claim maximum 120. And there is one more thing. If this is the person who is insured is physically handicapped, in case of that person is disabled, then we can give deduction of, we can claim 15% of sum assured. 15% of sum assured. Right? Please remember this. Although there is one more point. So from first, you have to remember this date only, 1st April 2012. If it is before 20%, if it is after 10%, but if the person for whom the policy is taken, let's say assessee is paying LIC for their daughter, and their daughter is, let's say, disabled. The daughter is disabled. So if in that case, that assessee can claim 15% of sum assured. But please remember one more thing, although that is not very important, from this date till 1 year, up to that is 31st of March 2013, this physical disable concept was not there. This physical concept was not there. For if the policy is taken during this 1 year, then only 10% you have to take for all type of people, whether they are disabled or whether they are not. Only 10% you have to take. But after 1 year, it was now 10% for other people and 15% for disabled, right? So this was important. So for LIC, you have to remember the date. Only this date. Please don't remember all these dates. Only this date is important. And by this date, if you remember this date, then you can build the story, right? So before that, that is up to 31st March 2012, premium to the extent of 20% of sum assured. And if it is between 1/4/2012 to 31st March 2013, that is 1 year. Only we have to take 10%. But after 1 year, it is 10% for sum assured. But if in case the person is disabled, then we have to take 15% of sum assured, right? So this is important. In ATC, generally, if examiner will ask you question regarding ATC, then they will ask you regarding LIC premium. Okay. What are the other types of investment where we can make the payment? So if you take ULIP, unit linked insurance plan, or any plan of LIC mutual fund, then also you can make the payment. ATC is allowed, right? ULIP. So again, self, spouse and children is covered over here. In ATC, please remember, in ATC, parents are not covered, right? HUF is simple, any kind of HUF. HUF. So first of all, please remember, in ATC we have done LIC, then is ULIP, unit linked insurance plan. Third is contribution to statutory provident fund or recognized provident fund or public provident fund. First, let me explain about this statutory provident fund and recognized provident fund. Do you remember the salary chapter? So in salary chapter, in revision also, we have discussed this in detail. So in salary chapter, we have discussed that if there is an employee, he's getting remuneration from his employer, and employer is also contributing to recognized provident fund, then it becomes the income. And whatever this employer contributing, it becomes an income. And also we give deduction also up to 12% of the retirement benefit salary. We give deduction also. Let me explain this. See, let's say there is an employee. He's working with some company. Let's say company name is Tata Motors. So Tata Motors is giving him basic salary. I'm talking about the employee, right? Employee is getting basic salary. Employee is getting DNS allowance. And also Tata Motors is contributing some amount to their recognized provident fund. I can take recognized provident fund, statutory provident fund also. So if they are making, they are contributing some amount to statutory or recognized provident fund. So first of all, we will write employer contribution. So you remember the salary chapter I have discussed with you, that whatever the amount which we receive from employer, we have to make a list of it, right? In salary chapter revision, we have already discussed this. So let's say employee is getting basic salary, DNS allowance, and employer contribution to provident fund. Let's say it is statutory or recognized provident fund, right? So if employer contribution to recognized provident fund, we will make it income. But here we give deduction also. We give exemption also over here. How much is the exemption over here? If it is statutory provident fund, then it is entirely allowed. And if it is recognized provident fund, we give a deduction of 12% of retirement benefit salary, which we already know. So we understand. So the point here is, whatever the employer is contributing, we are getting the deduction there as well. In the salary itself, we are getting the deduction. So whatever employer is contributing, mostly I'm getting a deduction. Even employer contributes, even practically employer does not contribute more than 12%. So practically we get the deduction there itself. But tell me, whatever is the employee contributing, I'm talking about the employee contribution, because we understand that employee also contributes. I'm talking about employee contribution. This is nothing. This is not income, right? This is not income, but this is a kind of investment which I'm making. The same way where I am making an investment in LIC or ULIP, I'm making an investment. The same way I'm making an investment in this recognized provident fund or statutory provident fund. So whatever employee is contributing, that deduction is covered under ATC. That deduction is covered under ATC. So first of all, if this question will come in your examination, let's say it's a mixed question of salary also and of ATC also, deduction also. So first calculate your salary income. So first, whatever is the basic salary, apply all those salary provisions, right? Then you will get gross salary. Then after giving deductions of section 16 standard deduction and all, you will get salary income, right? So let's say you have got your salary income, then your GTI you get, right? Let's say your whatever is your GTI, here you calculate your GTI. So now you have to, under section 80C, what you will give a deduction? Under section 80C, we know LIC, we know ULIP. Now the third thing is employee contribution. Why not employer? Please tell me why not employer? Sir, employer contribution is already been deducted at the time when salary income was computed, right? So here only we have given the deduction related to employer contribution. Here it is only and only employee contribution. So in 80C, we get deduction of employee contribution to whether it is statutory provident fund, it is also allowed, or it is recognized provident fund, it is also allowed. Now your question could be, sir, what about unrecognized provident fund? No, boss. If it is unrecognized provident fund, then it is not allowed. Give me a minute. I'm sorry, guys. Okay, so if it is unrecognized provident fund, URPF, boss, it is not allowed. It should only be SPF, it could only be RPF, then only it is allowed. If it is URPF, it is not allowed. And what it is? This is employee contribution. Why not employer? Sir, employer contribution deduction has already been given above only when we were calculating salary, right? So this is SPF, RPF, URPF is not allowed. Now, we know there is also a type of investment. It's a long-term investment in PPF, Public Provident Fund. Public, it is public. Who can open it? Any person. Any person can open it, and it is a kind of long-term investment, because you cannot, if you open a saving bank account, you can anytime you can withdraw the amount. But in PPF, you cannot. It is restricted, right? It is a kind of long-term investment. You cannot withdraw the amount from here unless and until a specific time is expired. So it is a kind of long-term investment. So you are giving this money to the bank. Indirectly, you are giving this money to the government for a long-term period, right? That is the reason they are giving you this deduction of PPF. And an employee can also open it, because this is opened in any of the bank like SBI or PNB open such account. So any person, let's say I'm not getting any salary income, but I have my PPF account, right? I have opened it myself. So you can also open it. Students can also open this account. Sir, whether an employee who is working somewhere, who is having RPF or PPF, they can also open it. Yes, this can be opened by any person. Sir, if he has RPF also, why is he opening it? Boss, he wants some investments, right? So he would like to keep his amount in different types of investment. So if the person is an employee, this RPF is opened by his employer, right? Till the time he is working in that organization, the amount will be credited here by his employer, right? Although there is employee contribution also, but that amount is deducted first from your salary, then only the employer can deposit the amount, right? If you want directly, you can deposit the amount. No, only the employer in SPF, RPF, etc. This is employees provident fund, right? But PPF is public. Public here means any person of any public person, that is any person of the society can open this. So whether you are an employee, whether you are a non-employee, you can open this PPF account. So if you open this PPF account also, if you deposit the amount, 80C is allowed. This is an eligible investment under section 80C. Got it? So here it is mentioned, statutory provident fund, recognized, unrecognized is mentioned over there. No, unrecognized is not over here. So, and this is PPF also. In whose name PPF can be opened? See, statutory recognized will be in the name of employee itself, right? But PPF can be opened in the name of self, spouse, children. Here also, please remember, parents are not covered. Please remember this point, under 80C, parents are not covered. Correct? Okay. HUFSSC for any member of HUF. Contribution to approved superannuation fund. Whose contribution? It is employee contribution. So if the assessee, if the assessee is an employee, let's say assessee is an employee, I'm taking the same example. Assessee is an employee, and this Tata Motors has opened a superannuation, approved superannuation fund also for him, where Tata Motors is also contributing and employee is also contributing. So in 80C, I'm discussing about employee contribution. Whatever the contribution which is being deposited here, which is related to employee contribution, that deduction can be claimed under section 80C. Right? Got it? Sukanya Samriddhi account, you understand that this is account which is introduced by government for the girl child. So you don't have to remember all these things. But please remember that Sukanya Samriddhi account is also a kind of eligible investment under Section 80C. National Savings Certificates, NSC. NSC, it's a 7 years NSC, 8 years NSC. You purchase these NSC from post office. And this is again a long-term investment. So if you have purchased NSC also, then also deduction is allowed in Section 80C. And approved annuity plans. Annuity plans is where you keep on depositing a regular amount in these types of funds. So these plans are mainly introduced by LIC. You don't have to remember the name. This is New Jeevan Dhara, New Jeevan Akshay 1, Akshay 2, Akshay 3, or any other insurer. So these are kinds of annuity plans. So these insurance company used to float these plans that if a SECI would like to invest in these plans. So let's say a SECI is 30 years of age right now. He's in active service or active. They are doing their own business or profession. And for their retirement, they would like to save the money. So every year, right now, the SECI is just 30 years. So now he's depositing. He's just depositing this amount in these plans. After 30 years, he will receive a lump sum amount, right? So these are approved annuity plans. Here also you can deposit. Notified units of mutual funds. So there are certain mutual funds. Can you purchase mutual fund units? Yes, we can purchase mutual fund units. So if I am purchasing any mutual fund unit, whether it is eligible, no, not in any mutual fund. So these are mutual funds which are related to tax savers mutual funds. And they have a lock-in period also of, this is just for your knowledge. They have their lock-in period also for 3 years. They have lock-in period for 3 years also. So if you are investing in such mutual funds, not any mutual fund, right? It is only for tax saving schemes, tax saving mutual funds. So here I have already mentioned notified mutual funds. So also, although in your examination, if it is mentioned that a SECI is investing in mutual funds, and if nothing is mentioned in your examination, please consider that these are tax saving mutual funds. So here, if you are purchasing mutual funds, and these mutual funds are generally long term, not less than 3 years. So their investment, these 80C, please remember this thumb rule. Remember this thumb rule. This 80C is available. This 80C is available only for long-term investment. If you are making any short-term investment, then 80C is not available. This is only for long-term investment. So if you have purchased some mutual funds, so notified units of mutual fund, you can put the amount over here. Then you can claim deduction under 80C. Notified pension funds set up by mutual funds or UTI. Pension funds which are set up by any mutual funds or UTI. UTI Unit Trust of India. Why I'm emphasizing on this point, pension fund, because we have section 80CCC also. There also pension fund is written over here. But there the pension fund is written off related to LIC or other insurance company. Here pension fund is written of mutual fund. So if you are investing in a pension fund which is floated by any mutual fund or unit trust of India, then 80C. If this pension fund is by LIC or other insurance company, then 80CCC. Otherwise, no, there is no much difference. Why? Because the overall limit is 150, right? From 80C also, 80CCC also, the overall limit is 1,50,000. So we don't really care in practical life, right? But yes, for examination purpose, if this pension fund is by mutual fund or UTI, then 80C. Let's cover 80CCC also. Let's cover 80CCC also. See, 80CCC also pension fund is written over here. But please remember, these pension funds are by LIC or other insurer. There, the pension fund was related to mutual funds or UTI. So again, we understand that the total deduction is available only for 1,50,000. But in 80CCC, so 80CCC, the eligible SSC is only individual SSC who are opting optional scheme. Obviously, we understand, and for new tax regime, 80CCC will not be available. Can HUF claim deduction under 80CCC? No, it is only for individual SSC. How much? 150. And this 150 limit is a standalone limit, or it is sharing with 80C also. So they share this 1,50,000 limit is 80C, 80CCC, this section, and 80CCD1. 80CCD1. These all three aggregate is 150. So 150 limit is here as well. And here the pension fund is related to LIC or other insurance. And it is also written over here that if the assessee has already taken deduction under 80C of any pension fund, then he cannot come in 80CCC, right? So if we have claimed deduction under 80C, then we cannot come in this particular section, right? So please, 80CCC is this one. Please remember this is related to pension fund, but hardly it comes in examination, a least important section. So this was related to pension fund. National Housing Bank tax saving scheme. So if you invest in, this is National Housing Bank, which are related in giving finance to the home buyers, and these housing bank also needs money. So they issue their securities, they issue their long-term securities, and if we purchase their long-term securities of National Housing Bank scheme, then 80C is available. So this is, please remember, only for examination purpose, National Housing Bank, NHB, remember this thing. Payment of tuition fees, favorite for the examiner. They ask questions on this particular point also. So if you assessee is paying tuition fees, what is tuition fees? Sir, where we go after school, that is for 1 hour or 2 hours, that is tuition. No, here tuition means mainly school fees or college fees. The fees which school charges or the college charges. This is for full-time education in India. Full-time education in India, but maximum for 2 children. See, if the school is charging transportation charges or any other development charges, that is not covered. Only related to study charges, that we call tuition fees. So if the payment is made for tuition fees for assessees to children, and I tell you in Income Tax Act, whenever we refer this word children, so children also includes your adopted child also, your legally adopted child also, and stepchild also, right? So for maximum, please remember this thing, for 2 children, and for full-time education, not for correspondence courses, not for part-time courses. It is only for full-time education. School is a kind of full-time, or college should be full-time, right? So school or college fees and other fees, transportation, other development fees is not covered. Please remember, tuition fees is is a quite favorite for the examiner. They generally ask about tuition fees. Please remember, only for 2 children, and this school or college should be situated within India. Housing loan principal repayment. What is this housing loan principal repayment? Let's say assessee has purchased a house, or they would like to construct a house, and if they take loan from any bank, if they take loan from someone, so let's say they have taken a loan from a bank, they pay EMI. That EMI, equated monthly installments. EMI has 2 parts. One is interest and second is principal repayment, right? So for if the assessee is paying interest for the year, then interest deduction is available in house property. In section 24B, we understand interest payment is related to in 24B. Although we have some sections 80 EE, 80 EEA, which I'll be discussing, but here in 80C, this interest is not covered because this interest is already in 24B. I am talking about this principal repayment, whatever the loan amount which is getting repaid, the principal repayment, whatever the assessee is paying, they can claim deductions under 80C. So this is related to principal repayment. So if the assessee has amount borrowed for purchase or construction of their houses of residential house property, then they can claim deduction under this particular house. It should be residential house property. Second thing is that it also includes your stamp duty or registration fees charges. Stamp duty. Let's say if you are purchasing a house, you understand that there is a state stamp duty also. You have to get your house registered in your name, and in that case, you have to purchase stamp papers also. You have to pay stamp duty also. So whatever the stamp duty you are paying, that is also an eligible eligible deduction under section 80C. You can claim that deduction also. But there is one more point over here, that for this house, if you are claiming deduction, you should not transfer this house before 5 years. You have to keep this house for 5 years. And if you transfer, let's say if you sell this house before 5 years, then whatever the deduction you have claimed, it will become your deemed income. It will become your deemed income. So it is written over here that this house should be with you for 5 years. Let's say in first year you have claimed deduction, in second year you have claimed deduction under 80C. And in the third year, you have sold this house. that is before 5 years, that whatever the deduction which you have claimed in first year and second year, it will become your income in third year, right? Okay. 13 point is equity shares or debentures of an undertaking which is engaged in infrastructure development. Here, can you purchase equity shares or debentures of any company? Although we can purchase of any company, but 80C deduction is available only in the case when you have purchased equity shares or debentures of infrastructure company, and the minimum time of investment, the minimum lock-in period is 3 years. Is 3 years, right? So if you purchase equity shares of infrastructure company, what is infrastructure company? See, our government would like to develop the country. They would like to develop the economy. So why, when economy will be developed? So if we have infrastructure facilities in place, if we have flyovers, if we have dams, if we have bridges, if we have trains, we have metros, we have other trains, right? Then in the country will be developed. So they want that people should invest on in these companies, such companies which are engaged in infrastructure development, like NHAI, right? So if you are purchasing the shares of infrastructure development companies, and that to a minimum period for 3 years, 3 years, then on those equity shares or on those debentures where you have made an investment, you can claim deductions under 80C. Okay, so it is for any shares or only for infrastructure development? Only for infrastructure development. Next is subscription of units of mutual fund that we have discussed. Any mutual fund or tax saving mutual fund? Tax saving mutual fund. Investment in 5-year term deposit. So if you go to the bank and if you ask the manager over there, sir, I would like to make a FD, fixed deposit, and that is for minimum period, I would like to get a 80C also, then that manager will say, okay, we will provide you with a special FD. In this special FD, the rate of interest is a bit higher, but there is a point over here that you cannot break this FD before 5 years. This is for 5 years. You have to make an investment for 5 years. So if you are making an investment for 5 years for minimum FD, minimum term deposit is nothing but for a period of minimum 5 years over here. So if you are making a 5-year term deposit, then you can claim a deduction over here. Or a 5-year post office time deposit also it is allowed. Notified bonds issued by NABARD. Please remember NABARD. If you are investing in NABARD bonds, then ETC is allowed. Senior citizen savings scheme is allowed. And NPS, new pension scheme. Although we will do NPS in section 80CCD, but here also deduction is allowed. But this is tier 2 NPS. This is not tier 1. Actually, in 80CCD, when once the next section is now 80CCD because we have already discussed 80CCC. In 80CCD, I'll tell you, this is new pension scheme which is floated somewhere in the year 2004. It is also known as central government new pension scheme. It is also known as in the name of Mr. Atal Bihari Vajpayee, Atal Pension Scheme Yojana. So if 80CCD NPS is mentioned over there, but it is tier 1 NPS. Tier 1 NPS means here you have to make an investment that is for a long-term investment. But there is also pension scheme which is tier 2. Tier 2 is a kind of voluntary investment. Here you can, this is not compulsory that you have to make an investment. This is a kind of voluntary investment, and also the withdrawal restrictions are quite less over here. So tier 2 investments of NPC are covered in 80C. Tier 1 is in 80CCD, right? In 80CCD 1, 1B or 2. But tier 2 types of investment are covered in 80C. So tier 2 is an additional account under NPS. This deduction is only allowed for central government employees. But this is only for central government employees, not for everyone. And what is tier 2? See, I have mentioned it over here also. This is just for knowledge sake. New pension scheme provides 2 types of accounts, tier 1 and tier 2. Tier 2 is a voluntary saving account and offers greater flexibility in terms of withdrawal also. So here the restrictions are not that restricted, right? In tier 1 there are quite restricted, but in tier 2 it is kind of flexible investment. And but tier 2 is only, it is not for all SSC, it is only for central government. Don't remember this. Just remember that tier 2 investment. Although 19 point is not very important for ATC because they will just ask you about new pension scheme and they will refer to section 80CCD, right? So this was about 80C. So this is a type of investment. We have already discussed now 80CCC also. This is related to pension fund. Pension fund of what? Pension fund of LIC or any other insurance company. If it is for pension fund of mutual fund, then it is covered in 80C. Getting it? Okay. Let's come to 80CCD, new pension scheme. This is an important section. This is an important section. What happened? Give me a moment. This is an important section, guys. 80CCD. This is new pension scheme. It was introduced in 2004. You don't have to remember this number. See, as I have already mentioned, 80CCD has three parts. One is 80CCD1, 80CCD1B, and 80CCD2. What is 80CCD? This is related to new pension scheme. These two are related to employee contribution. Employee contribution to new pension scheme. And this one is related to employers contribution to new pension scheme. Got it? I'm again repeating. 80CCD has three parts: CCD1, 1B, and CCD2. These two are related to employee contribution whenever the employee is contributing, or I can say not only employee, I can use another word also. Instead of employee, I can use another word also, assessee contribution. Assessee is contributing, right? Here, 80CCD to assessee's employer. If assessee is, let's say, working, then their employer is contributing, then 80CCD2 is allowed. First of all, if the assessee is following default tax regime, they are opting for 115 BAC, then only this deduction is allowed for them. Only this deduction is allowed for them. But if the assessee is following optional old tax regime, then all these deductions are allowed. All these deductions are allowed. Are you all getting this? So if the assessee is following optional tax regime, all three deductions are allowed. But if the assessee is following new tax regime, only this deduction is allowed. I believe that you are getting this. As I have already mentioned with you, let's say if there is an employee, Mr. A. Mr. A is an employee and he is working with Tata Motors Limited. Tata Motors Limited. And Tata Motors is giving them salary. Let's say they are giving them basic salary to Mr. A. They are giving dearness allowance to Mr. A. And they are also, here Tata Motors is also contributing to employer contribution to pension scheme. They are also contributing to pension scheme, boss. In that case, please, whenever you are calculating your salary income, please make it part of your salary. Make it part of your salary, because in salary, what I have explained it to you in salary revision, whatever you are getting from your employer, please make it part of your salary. So if you are getting basic salary, dearness allowance, any types of allowances, any types of perquisite, make it part of your salary. And here, if your employer is also contributing, make it part of your salary. Please write over here, employer contribution to pension scheme. Whatever the amount is contributed by the employer, please make it part of salary. And while computing this particular portion, do you have to give any deduction related to pension scheme? The answer is no. You don't give any deduction while calculating your salary. If it would have been your provident fund, I have already explained it to you some half an hour before. I've already explained it to you. If it would have been your recognized provident fund or statutory provident fund, in that case only, and only provident fund, then you can give deduction over here. But if it is pension scheme, then you don't have to give any deductions here. And if it is pension scheme, please do not give any deduction over here, right? In that case, first of all, make it part of your income. Basic salary, DNS allowance, employer contribution to pension scheme. Please make it part of your income first. Please make it part of your salary. Don't give any deduction. Whatever is your salary, calculate your gross salary. Then after that, calculate your net salary, whatever it is, after giving deductions. And then once you receive your GTI, now you have to give deductions of 80 CCD1. If 80 CCD1B is also there, give deduction. And 80 CCD2, which is related to employer contribution. Why you are giving this employer contribution? Because here you have not given any deduction related to pension scheme. If this would have been provident fund, then you can give deduction here itself. But if it is related to pension scheme, you give deductions over here. So now you can relate. In 80C, we were giving deduction only related to employee contribution. Why only employee contribution, not employer? Because in provident fund, we have already given the deduction earlier while calculating salary. Getting it? But here in 80 related to pension scheme, you don't give deduction over here. You give deduction here itself, right? And this 80 CCD2 is available in both the tax regime, whether the assessor is following new or they are following your old tax regime. Got it? So this is the basic background of section 80 CCD. Now, if here the maximum limit is 1,50,000. Here the maximum limit is 1,50,000. In 80 CCD1B, this 1,50,000 limit is not applicable. In 80 CCD2, 1,50,000 limit is not applicable. 80 CCD1, 80 triple C, which we have discussed, 80C, these are covered under 1,50,000 limit. Got it? Now, what is 80 CCD1B? See, if the employee has contributed some amount in national pension scheme, let's say there is an assessee, Mr. A, he has contributed to, he is paying tuition fees for his 2 children, let's say 80,000 rupees. Okay. And he has also purchased bonds of NABARD, let's say rupees 30,000, that is 1,10,000. He has purchased the bonds also 1,10,000 rupees, right? So in 80C, he will claim deduction of 1,10,000. And also Mr. A, this is employee contribution to pension scheme, and he has contributed, let's say, rupees 7. He has contributed, let's say, rupees 1 lakh. He has contributed 1 lakh in pension scheme also. So what you will do is, first of all, while calculating deductions under chapter 6A, first of all, you will give 80C deduction. 80C deduction would be how much? 1,10,000, right? And how much would be 80 CCD1? That this is employee contribution. Can you, sir, he is paying 1 lakh rupees. So can you give deduction of 1 lakh in 80 CCD1? The answer is no, because the total amount deduction which we can claim is 1,50,000. So it means that in 80C you are already claiming 1,10,000. So here you cannot claim 1 lakh deduction. How much you can claim? So the maximum is 150. So from here in 80 CCD1, maximum which you can claim is 40,000. You can claim is 40,000. That is the reason now it is 150. So please tell me how much the employee is contributing. So the employee is contributing 1 lakh. But in 80 CCD1, how much deduction he gets? Just 40,000. Why 40,000? Because this 150 limit was already exhausted by other sections, right? So here you can claim only 40,000 deduction. So here we have already claimed how much deduction? 40,000. But the question is, what will happen to our 60,000 amount which we have contributed? So for that, 80 CCD 1B will help. 80 CCD 1B will help here. If say, well, 80 CCD 1B says, if we are not able to claim deduction, under 80 CCD 1, why we were not able to claim? Let's say the limit was exhausted over there. So then we can claim deduction in 80 CCD 1B. Then we can claim deduction in 80 CCD 1B. That is also employee contribution or assessee's contribution. And how much we can claim? Maximum 50,000. So 80 CCD 1B has their own limit of 50,000. Here you can claim maximum 50,000. So in this case, so there was 60,000 limit which was still there, which is tried. We will try to use this also, but how much we can use? Only 50,000. This 50,000 is from 80 CCD 1B. Got it? So this is 80 CCD 1B. This is 1B, and then we have 80 CCD2. 80 CCD2 is related to employer's contribution to NPS. This is employer contribution to NPS. Whatever the employer is contributing, you can claim deduction, but how much deduction you can claim? There is a limit also. So let me read this first. See, 80 CCD, new pension scheme. 80 CCD1 and 80 CCD1P. This is available only for individual who opts for optional tax regime. 80 CCD2 is for both the tax regime. This is assessee's own contribution. This is employer contribution, right? Amount of deduction under 80 CCD1. 80 CCD1 is restricted to 1,50,000. First of all, please remember this is restricted to 150. But there is one more internal limit to it. How much is the internal limit to it? If the assessee is salaried assessee, then maximum 10% of salary. There is an internal limit to it. Maximum 10% of salary. Salary here means basic salary plus DA forming part of retirement benefits. Only please consider only basic salary and DA forming part of retirement benefits. So here the limit is 10% of salary. But it is for salaried assessee. If the assessee is non-salaried, please tell me if the assessee is a non-salaried assessee, then also they can claim deduction under 80 CCD? Yes, they can claim. Let's say if I am a non-salaried assessee, I'm not getting salary from somewhere around now, right? I have my own business and profession. So in that case, can I claim deduction under 80 CCD? Yes. Sir, how much? 10% of salary, but I'm not getting any salary. Why? Then, first of all, 80 CCD2 will not be available for me. Why not available? So because I don't have any employer. Then they are giving me deduction in 80 CCD1 and 80 CCD1B. They are giving me a deduction. They are giving me a more deduction. How much? For salaried assessee, it was 10%. Why 10%? Because he will get 10% from here also. But for non-salaried, this deduction was increased to 20%. So this is for 20%. And 20% of salary or 20% of GTI. For non-salaried, it would not be salary, it would be GTI. So for other assessee, amount contributed in NPS, maximum 20% of GTI, right? And this I have already discussed. 80C, triple C and 80 CCD1, maximum limit is 1,50,000. This is given by 80 CCE. Amount of deduction under section 80 CCD 1B, assessee's contribution. 1B is also assessee's contribution. How much he can claim? Sir, maximum 50,000. When he can claim? If he is not able to claim the entire deduction in 80 CCD 1, then he can claim deduction of 80 CCD 1B. Okay. And in 80 CCD 2, the employer contribution can be claimed if the assessee is a central government, state government employee. Please remember 14% of salary. If they are other employee, then 10% of salary. For central government, state government, it is 14% of salary. And for other employees, it is 10% of salary. Right? These all things I have already discussed. Last point about NPSs. This can come in your examination. This is again important. If the employee withdraws the amount from new pension scheme, that at the time they are closing this amount or they are withdrawing this amount, then what will happen? If the amount is withdrawn on the death of the subscriber, the person in whose name NPS was there, that person is now died, and then their legal heirs are withdrawing the amount, then it will be fully exempt. But if there is no such case of death, if the person himself is withdrawing the amount, first we have to ask whether you are closing your NPS or you will continue with your NPS. That is withdrawal on closure of NPS. If you are just closing your NPS entirely, then you are withdrawing the amount, then 40% of such amount will be taxable, 60% will be exempt under section 10. You don't have to remember the full number, but please remember this percentage. This is something which is important. This can come in an examination. Please remember this percentage. So if the assessees, there is death of the assessee and if their family member legally is withdrawing the amount, fully exempt. But if there is no case of death, the assessee himself, they are closing down their NPS scheme and then they are withdrawing the amount. 60% of that amount will be exempt, 40% will be taxable. But in case of partial withdrawal, they are not closing this amount. They are just withdrawing some part of from NPS. Then whatever the amount they will withdraw, 75% will be taxable. 75% will be taxable, 25% will be exempt. But if this person is a non-salaried assessee, entire amount will be taxable. This is only 75% and 25% is only for salaried assessee. And if they are non-salaried, then whatever the partial withdrawal they are making, entire amount will be taxable. So this is for any person, whether they are salaried, they are non-salaried. If they are closing down their NPS, 40% will be taxable, 60% will be exempt. Got it? Now we'll continue with our next section, 80 CCH Agnipath scheme. Should we take a break right now? Okay, let's discuss this section first and then we'll take a break of 10-12 minutes, right? Okay. 80 CCH, a very easy section and important also. Why important? Because this has recently been introduced. This has recently been introduced by our by the amendment by Finance Act 2023. This has been introduced. So this can come in your examination. See, I've written it also. This is an amendment. Finance Act 2023 has given this. So what is Agnipath scheme? This is for the people who are joining armed forces, Army, Navy, Air Force, and there's a scheme that if you will join it, we'll give you employment for 4 years. After 4 years, you will be retired. They will be retaining 25% of the Agniveers. These soldiers are called Agniveers, and 75% they will retire. In that case, they will get benefit. First of all, they will get experience of 4 years working in Army, Navy, or Air Force. Second thing is that they will get several benefits in other employment also. They will get benefit from banks also. If they would like to start their own business, a profession, they can easily get the loan also from the banks. So there are several benefits which are available to them, right? And during this 4 years, they will be getting salary also. They will be getting salary also. So their salary will be taxable. No doubt, their salary will be taxable. Plus, central government, because this Army, Navy, Air Force comes under central government. Central government will also contribute something to their Agniveer Corpus Fund. So for them, there is a special fund which is known as Agniveer Corpus Fund is made, and central government will contribute in Agniveer Corpus Fund. And whatever the amount central government is contributing, matching amount is also contributed by Agniveer. Means the assessee will also contribute. So if assessee will contribute, this is just an investment. But if the central government is contributing, that is our income. So let's say, I give you an example. Let's say there is a soldier, Agniveer, Mr. X. Let's say he is getting basic salary. Whatever amount is getting basic salary, it will be taxable. He is getting any other allowance or perquisite, that would be taxable. And also employer contribution. And also employer contribution to Agniveer Corpus Fund. To Agniveer Corpus Fund, please make it taxable. Make it part of salary. While calculating your salary income, no deduction will be allowed there. No deduction will be allowed while computing salary income. Please make it entire taxable. Then compute his gross salary. After that, give standard deductions and all. And then compute your GTI, right? Net salary and then GTI. So whatever the GTI now you have, now you can give deductions of 80 CCH1 and 80 CCH2. 80 CCH1, whatever Mr. X is contributing, whatever the employee is contributing, then they can get deduction of 80 CCH1. whatever the employer here is central government. So whatever the employer is contributing, you can get deduction there as well. So here the employer contribution would be also allowed in 80 CCH2, right? Now, if the person is following new tax regime, then 80 CCH2 is only available. But if the person is following optional tax regime, both these deductions are allowed. See, it is written over here. So do this by chart. So 80 CCH1, CCH2. CCH2 is available only for new tax regime, whereas optional tax regime, if the assessee is following, both these are allowed. So this is for optional tax regime only, but this is for new tax regime as well as optional tax regime also. And whatever they are contributing, you will get the deduction. There is no limit here. Whatever they are contributing, you will can claim a deduction over here. So this was about 80C, 80 triple C, 80 CCD and 80 CCH. Now you can take a break of 10-12 minutes. Now you can take a break of 10-12 minutes and then we will resume after this time, right? Okay, guys, let's resume this. Okay, welcome back. So before this break, we were discussing 80 triple C, 80 CC, 80 C, 80 triple C, and 80 CCD, and also 80 CCH, which is a new section. Now let's come to 80D family. 80D family is related to, I normally say that these are related to sickness or disease. So when we'll be discussing 80D, 80 double D, DDB, etc. And these are related to diseases or medical treatment or medical insurance and all. So 80D says if the assessee is paying, first of all, it was related to if the assessee is paying for their health insurance. Please understand this is not life insurance, this is health insurance. So if the assessee is paying for their health insurance, then it is allowed under section 80D, right? And it is also for government employees, it is also for they have their own health insurance if they are contributing to central government health scheme CGHS, which we call. Then also if they are contributing to CGHS, then deduction is also allowed. And we understand if the assessee or their parents are, let's say, senior citizen. In fact, if they're super senior citizen, let's say if they are 80 years of age, and even if they are 70 or 70 plus of age, then these insurance policies are quite reluctant in giving in providing insurance for such people who are of old age. Why? Because see, if the person is of a very old age, in that case the probability that that person will be sick is quite high. So these insurance companies, they don't give insurance to such people. So in that case, if the assessee is paying premium for their mother or father and they will not be getting the facility of 80D, so in that case also 80D says that if the insurance could not be done for your parents, or if the assessee himself is a senior citizen, and if the if you are not getting insurance policy, even if the expenses which you are paying for your medical treatment, then also it is allowed under 80D. So to sum up, 80D says your health insurance, not life. It should be health insurance premium. And we know that for health insurance, we have different names like accidental insurance policy or Mediclaim policy or health insurance policies. These are one and the same thing. So if the assessee is paying premium for these health insurance policies, accidental, medical insurance, or by any other name, then it is allowed. CGHS scheme is also allowed. And third thing is, if in case if the assessee or their parents are a senior citizen and if they are not getting the insurance, then if they are making a payment for their medical treatment also, then also it is allowed. And whether an assessee who is claiming deduction, who is opting for new tax regime, can they claim deduction under 80D? The answer is no, because we understand that for them only three sections are allowed: 80CCD2, 80CCH2, and 80JJA. So this is only for those individual or HUF who are opting optional tax regime. So whether that person is a resident or non-resident, 80D is allowed. So if they are paying for medical insurance, health insurance, or payment to CGHS scheme, that is also allowed. Preventive health checkup, I'll tell you what is preventive health checkup. And also for medical insurance for senior citizen who are 60 years or more. Why? Because in that case, that person is not getting insurance. So that is the reason they are giving us a facility that even if you have spent something on medical treatment, then it is also allowed. This is for senior citizen. And whenever this point of senior citizen, there is a thumb rule. Whenever this point of senior citizen comes into picture, then we give this facility only to resident. So if that person is a senior citizen plus resident, then only medical expenditure is allowed. If that person is a non-resident, then medical treatment is not allowed, right? But yes, this deduction can be claimed by assessee who is resident or non-resident. Let's say the assessee is non-resident, but his father or mother is resident, and for them he is incurring medical treatment expenses, then it is allowed, right? And if their mother and father is also non-resident, then it will not be allowed. Okay, amount of deduction. If the assessee, how much is the maximum amount which assessee can claim? Generally, it is 25,000. 25,000 for self, spouse, and children, self, spouse and children. And here children can be dependent, non-dependent? No. In 80D, the children should be dependent. So it is 25,000 maximum limit for self, spouse and children. And for parents, we have one more limit of 25,000. So total it can make to 50,000. So again, I am repeating, if the assessee is taken insurance or they are paying for CGHS schemes and all, for self, spouse and children, it is 25,000 maximum limit. For parents, we have additional 25,000. And also, so total we can go to maximum 50,000. But also, if the assessee is a senior citizen, is a resident senior citizen, or their parents are resident senior citizen, then this limit of 25,000 will be increased to 50,000. Let's say assessee is not a senior citizen. For them, they can get a deduction of maximum 25,000, but their parents are senior citizen. So for them, this 25,000 will be increased to 50,000. So total it will become 75,000 deduction. Let's say the assessee himself is a senior citizen or their spouse is a senior citizen. Then for them 50,000 and additional parents will obviously be senior citizen. If the assessee is senior citizen, then the parents will obviously be senior citizen. It will be 50,000 again for them. Got it? So for self, spouse and dependent children, only dependent children are allowed. Non-dependent is not allowed. In 80C, we have discussed that in 80C, children could be dependent or non-dependent, but here it is only dependent child. 25,000 or 50,000 in case if any of the person is a senior citizen, and whenever the senior citizen facility is given, we understand it that person should be resident. For parents, parents can be dependent and non-dependent. Now please remember, if assessee is paying life insurance premium for parents, whether they are dependent, non-dependent, 80C it is not allowed. But if the assessee is paying health insurance premium, I am saying, if the assessee is paying for health insurance premium, then it is allowed under 80D. Whether that parent is dependent or they are non-dependent, there is no problem. They can get a deduction of 25,000. And if they are senior citizen plus resident, 50,000, right? For HUF assessee, they can make a payment for any of the member of the HUF. Maximum limit is 25,000. And if the assessee, if the person for whom they are making this payment is a senior citizen plus resident, then 50,000. Got it? Simple. Second thing is that if the assessee, also one more point is there. If assessee is spending for, if the assessee is spending for preventive health checkup, they are getting their health checkup done, or for their parents, they are getting health checkup done, then 5,000 limit is allowed for preventive health checkup. But please remember that 5,000 limit is not over and above this limit. It is within this limit of preventive health checkup. And whether it is 5,000 for self, spouse and children, 5,000 for dependent, parents or non-dependent, no, 5,000 is entirely 5,000. It is 5,000. This is within this overall limit. Second thing is 5,000 is for the overall limit for everyone. And we also know that if assessee is paying for medical insurance premium or any other amount, it should not be by way of cash. It should not be by way of cash. It should be account pay check, account pay demand draft, or any other electronic or banking mode, right? But for preventive health checkup, it can be by way of cash also. For preventive health checkup, it could be by way of cash also. But maximum deduction is allowed for preventive health checkup is 5,000. What is preventive health checkup, by the way? It is nothing that you get your body checkup done. If you're getting your body checkup done to just get to know whether if you are suffering from any disease or any type of ailment, so people usually get their medical medical checkup done. That is a full body checkup. That is nothing but a preventive health checkup. The name itself suggests preventive health checkup. You are getting a health checkup done so that if you could diagnose any type of disease, so you can get it prevented at a very early stage, right? So that's called preventive health checkup, but maximum limit is 5,000. Okay, so this is again written over there for preventive health checkup. It can be paid. Preventive health checkup can only be paid in cash, but other things should be paid by any mode other than cash. Mode of payment I have discussed. Medical expenditure I have discussed, because they are not getting their health insurance coverage. That is the reason medical treatment is also covered over here. So to sum up, medical insurance premium is allowed, CGHS scheme is also allowed, preventive health checkup is also allowed, medical expenditure is also allowed. But for CGHS scheme, this is not that important for examination. But yes, it is there in the syllabus. That is the reason I'm discussing this. For CGHS scheme, if the assessee is paying for parents or if the HUF is paying for members, then it is not allowed. CGHS scheme is only for self, spouse, or children, right? It is not for parents and members. But this is not that important for examination purpose. Okay, this point is important. Generally, these types of insurance, this is not life insurance. Life insurance is for a longer period. It is for 10 years, 15 years, 20 years. But these health insurance, they are known as general insurance. We understand these general insurance are generally for 1 year. Every year we have to get these insurance done. Their life is just for 1 year. So if you are paying for 1 year, you can claim a deduction. But in case there are some special types of insurance which have now recently been introduced in the market, that you can get the health insurance done for 2 years or 3 years. So if you are getting the insurance done for more than 1 year, so in that case, whatever the proportion amount, whatever the proportion period which is falling in your previous year, you can claim a deduction over here. Let's say if the assessee has made a payment for 24 months. So here, in this case, for 12 months, which are related to your period for previous year 23-24, whatever the amount which you have paid, whatever the proportionate amount which is related to this period, you can claim the deduction over in this year, and remaining can be claimed in other years. So how you have to do is, whatever the lump sum amount which you have paid for more than 1 year, just divide it by the period which is in force, and whatever is the period which is related to particular to your previous year, then you can take that period. That will be allowed on proportionate basis. This is easy. I believe that you will be able to do this. Right. Next section is, let me discuss this first, 80DD. 80DD is for if the assessee is maintaining any person who is wholly and mainly dependent on the assessee, and if they are their family members. Here family members includes could be spouse or children, or even parents and siblings also, brother and sister. If assessee has a brother who is disabled, he's either mentally retarded or suffering with some disability, in that case, if the assessee is maintaining that person, then assessee can claim a flat deduction of 75,000. Assessee can claim a flat deduction of 75,000, but assessee has to furnish a certificate. While furnishing their return of income, they have to furnish a certificate also. Now we understand these returns are paperless return. We don't have to attach anything. But yes, we have to give a details in the return about that certificate. We have to get a certificate from a medical authority, from a government medical authority, that this person is suffering with such disability. In that case, if we are maintaining that person, then we can get a flat reduction of 75,000. So you have to get a certificate also from the prescribed medical authority, generally from the chief medical officer. And if that person is severely disabled means that person is so much disabled with that particular disability that the percentage of disability is 80% or more, then that is called severe disability. So the whomsoever authority who would be issuing this type of certificate, they also mentions that how much percentage disability that person is having. Let's say one of the disability could be blindness. So if it is complete blindness, so it is 100%, right? If it is partial blindness, it could be 60%, 70%, 80%. So if it is 80% or more disability, then we call it as a severe disability. So in case of severe disability, we get a flat deduction of 1,25,000. So please remember, there is a flat deduction of 75,000. But if the person is suffering from severe disability over 80%, then it is 1,25,000. 1,25,000 is a flat deduction. Let's say assessee has made any expense, any medical treatment of, let's say, 5,000, 10,000. So irrespective of the actual expenditure, the assessee can claim a flat deduction over here, even if the actual expenditure is less or the actual expenditure is more. This 80DD, DD, disabled dependent, you can learn in this way, DD or disabled dependent. So in that case, assessee can claim a flat deduction of 75. In case of severe disability, 1,25,000 is a flat deduction, right? So, and this deduction is only available to resident individual or resident HUF. It is not for non-resident. 80D, that medical insurance, health insurance, it was available to resident assessee also or non-resident also. But here it is only for resident individual and resident HUF. And obviously, it is not allowed in new tax regime, only optional tax regime. If the assessee is maintaining a person who is disabled, if who is disabled, so for individual, the disabled could be spouse, children, parents, and brother and sister who are mainly dependent on this particular assessee. And if it is HUF, any member of the HUF. So if they have incurred expenses related to medical treatment, nursing, training, rehabilitation, etc., then in that case, irrespective of the expense amount, we can claim a flat deduction of 75,000 or 125 as the case may be. And even if the assessee has paid any amount for the insurance, let's say that person is disabled. There's an assessee, Mr. A. Mr. A's brother is disabled. So what Mr. A does is he gets an insurance done. He get an insurance done. Then in case if something happens to me, if Mr. A thinks that if something happens to me, who will maintain Mr. A? So he get a life insurance policy done for that. So in that case, if he is getting that insurance done for that particular person also, then in that case, that expense is allowed, but we can claim a flat deduction of 75,000 or 125. So it doesn't depend upon the amount of that premium, right? So here a flat deduction can be claimed. But let's say Mr. A's brother who was disabled, let's say he dies, and we get the claim from the insurance company. In that case, that claim is fully taxable. If that disabled person dies, and now who is getting this claim? Mr. A is getting this claim. So in that case, that claim is fully taxable. So here I have mentioned it here as well. If the disabled dependent dies and assessee receives the amount under the LIC or other insurance scheme, then it is fully taxable as IFOS. Right? And there's a flat deduction of 75,000 and 125,000. There is a similar section like 80DD. We have a similar section 80U. 80U. What is the difference between 80DD? They are almost similar. This is also related to disability. This is also related to disability. Here also a flat deduction of 75,000 or 125,000 is there. But here, if the assessee himself or herself is disabled, 80DD, the person who is dependent on the assessee was disabled. Assessee's spouse, assessee's children, assessee's parents, assessee's siblings, brother or sister. 80DD. But if the assessee himself is disabled, then they can claim deduction under section 80U. Otherwise, everything is same, right? So it is 80U if the assessee himself is disabled. So this was 80DD and 80U. The last section in 80DD family is 80DDB. 80DDB is that if the assessee is spending some medical expenditure on what type of disease, this is related to some specified diseases, some life-threatening diseases like cancer, tuberculosis, HIV, etc. So these are life-threatening diseases. If the person is spending the money, the medical treatment expenses, if the assessee is making, let's say for himself or for any of the dependent. Dependent here means the same thing. Spouse, children, parents, brother and sister, all are covered over here. So if the assessee is making the payment for disease treatment, 80DD was disability. Here it is disease, right? There's a difference between disability and disease, right? So here, if the person is suffering from that particular disease, those life-threatening disease, that's as I have already discussed, like cancer, tuberculosis, HIV, etc. In that case, whatever is the medical expenditure which the person is making, they can claim a deduction over here. But there is a amount, there is a restriction over here. Whatever is the amount which the assessee is incurring, or 40,000 rupees, whichever is lower. But in case if the assessee or the person for whom this expenditure is being made, if that person is a resident senior citizen, then this 40,000 limit will be increased to 1 lakh rupees. So let's say assessee is making an expense of, medical treatment is for that prescribed disease, let's say it is 52,000. 52,000 is the medical treatment. And if the assessee or the person for whom we are making this expenditure is not a senior citizen, then it is 40,000 limit, which we have to see whatever is the lower amount. So what is the lower amount? 40,000 is the lower amount. This is the deduction which we can claim under 80 DDB. But let's say, here is the point. But let's say if this assessee has also received anything from the insurance company, let's say if he has this insurance also, and for medical treatment he gets the amount from the insurance company. So first of all, you have to see the actual expenditure of 40,000 or 1 lakh, whatever the case may be, whichever is lower. First, come to this amount. After that, if the assessee has recovered any amount from the insurance company as an insurance claim, then whatever is the amount recovered should be deducted from this limit. So let's say if the assessee has recovered 12,000 rupees, please deduct this 12,000 rupees from this 40, and 28,000 is the deduction under 80 DDB, right? 28,000 will be the deduction. You don't have to deduct this 12,000 from this 52,000. No. First of all, whatever the expenses, the medical expenses which the assessee has incurred, please compare it with 40,000 or 1 lakh as the case may be. Lower of the following, first calculate the least amount, and then the amount which is recovered from the insurance company, deduct that amount, and this deduction can be claimed under 80 DDB. So this is, I have written it over here. The actual amount of medical treatment for self or dependent. Dependent here means we have already discussed in 80 double D. So whatever is the actual expenses, or 40,000, if the assessee is a senior citizen, or the person for whom this medical treatment is done, for the person for whom this medical treatment expenses are being incurred, if that person is a senior citizen, obviously resident, then we will give 1 lakh rupees maximum deduction. So first of all, calculate whatever is the lower amount. And from this lower amount, if any insurance claim is received, if nothing is received, then this is the deduction. But if any amount is received, then deduct this amount, and this deduction is available under 80 DDB. So this is the family related to 80D. We have done 80C. Now we have also covered the family of 80D. So what about the sections in 80C? So we have 80C, right? 80CCC, 80CCD, 80CCH. We have four sections in the family of 80C. In 80D, we have 3. 80D, medical insurance or health insurance, preventive health checkup, right? 80D, 80 double D, the person who is disabled dependent, 75,000 or 125,000 flat deduction, and 80 DDB for medical treatment. And we have already done 80U also if the assessee himself or herself is disabled. Okay. Now we are coming to the family of 80E. 80E. In 80E, this is 80E is related to, we will do some 4 sections over here. In 80E, we have 4 sections, although one of the section is not that important, 80EE. So here we will discuss 80E, 80EE, 80EEA, and 80EEB. There are 4 sections, and these 4 are related to interest. These are interest-based deductions. So when we pay interest, whenever we have taken a loan, and if we are paying any interest, then this deduction is available under these particular section: 80E, 80EE, 80EEA, and 80EEB. I tell you, $80E, $80EE, $80EEA, and $80EEB. This is related to, all these are related to interest. 80E is related to if the assessee has taken an education loan. Then deduction under 80E is there. 80E and 80EEA is related to if the assessee has taken a loan for purchase or construction of house. Then 80EE or 80EEA is there. When will 80EE will apply? When will 80EEA will apply? We will see that. So if the person is making a payment for his residential house, sir, for residential house we have another deduction in 24B. 24B, whenever we compute our house property income, then we can claim deduction under 24B. Guys, I tell you, this is over and above this 24B. So in 24B, we understand if the person is, first of all, if the assessee has a self-occupied house, and that person is claiming a deduction, is opting for new tax regime, then 24B is not allowed for self-occupied property. It is only in the optional tax scheme it is allowed, right? So in 24B it is allowed, but how much is the maximum amount? 24B is there, 2 lakh rupees. We understand for self-occupied property it is 2 lakh rupees only and only when the assessee is following optional tax regime, old tax regime, right? But let's say if the assessee is paying more interest, for example, the assessee's interest on housing loan is 2,90,000. So we understand maximum 2 lakh can be claimed. Let's say if it is self-occupied property, 24B, maximum 2 lakh can be claimed, and only when that person is following old tax regime, optional tax regime, right? So what will happen to that 90,000? 90,000 he cannot claim. So for that 90,000, we have these two sections. Right? So when we will apply 80EE and when we will apply 80EA, we have to see. But yes, 80E is related to education loan. 80EE is related to your housing loan. Over and above that 2 lakh rupees limit, because 2 lakh is allowed under 24B. Over and above we are paying interest, then we can go in this particular section. In 80EE, I'll tell you that there is a limit of 50,000. In 80EA, we have a limit of 150,000 that I'll discuss. And in 80EEB is related to if the assessee has purchased an electric vehicle, right? E-vehicle. It could be a 4-wheeler, it could be a 3-wheeler, it could be a 2-wheeler also, right? We have electrical scooties now. So if the assessee has purchased an electric vehicle and that assessee has taken a loan for that, in that case, he can claim deduction in 80EEB. So this is related to electric vehicle, 2-wheeler, 3-wheeler, or even 4-wheeler. Even if it is a personal vehicle, then also 80EEB can be claimed. And if it is for the business purpose, then AEB can also be claimed. 80EEB deduction can also be claimed, but there is one point that I'll be discussing with you. But please tell me, first of all, are you through with these 4 sections now? 80E family is related to interest family. 80E education loan, EE and EEA is related to your housing loan. 80EEB is related to your e-vehicles loan. Okay, let's discuss about 80E. So 80E is related to if the assessee has taken a education loan for education purpose, right? Let's say assessee himself or herself is going for further education, then they can claim a deduction for interest. If their spouse is going for education or their children are going for education, or for any of the child or any of the student for whom the assessee is a legal guardian, he has taken a responsibility legally that I'll spend for that particular student's education, then also 80E is available. So for parents, so practically it sounds quite unrealistic that assessee has taken a loan for their parents' education. So here it is only for the spouse, children, and for person for whom we are legally liable, right? So 80E deduction is only related to interest. So if we have taken a loan and if we are paying interest on that particular loan, that is only allowed. But maximum it can go for 8 years. From the date when you have started paying the EMI, from the date in the year in which you have started paying the EMI, you can go for maximum 8 years in this case. So if it is for higher education is any education which is after your school, that is after your class 12th. If you are going for any higher education and you have taken a loan, then it is allowed. So 80E says interest on loan for higher education. Can the assessee has opted for default tax regime? Can they come in 80E? No. 80E is only for, not for new tax regime. It is only for optional tax regime. Individual assessee who has taken education loan, right? Condition is it is for higher education. Any course after class 12th is allowed over here. And loan is taken for self, spouse, or children, or any student for whom the assessee is a legal guardian. Let's say assessee has taken for loan for his brother or sister. Yes, they can if they are legal guardian for his brother or sister. Loan can be taken from any financial institutions. Financial institution means like any financial institution like banks. It includes banks also. And any approved charitable institution. There are some NGOs who supports education. So if we have taken a loan from any approved charitable organization, then we can claim deductions under 80E. But please remember, only interest portion is allowed. What about principal repayment? No. Principal repayment is not allowed. Only the interest portion is allowed. Principal repayment was in 80C related to house property, right? And for how many years you have to hold that house property for 5 years. Otherwise, whatever the deduction which you have claimed earlier in 80C, it will become your income, right? But here, only interest portion is allowed. And also, whenever you have started paying the installment, it would be allowed from that year, and maximum for 8 consecutive years it can go. So this is important for MCQ. You should know about 8 years. So 80E is related to education loan, whereas 80EE and 80EEA is related to your home loan. And this is for those assessee who are purchasing their house for the very first time in their life. They don't have house earlier. They were not having any house earlier. They are purchasing this house for the very first time. So that is the reason this deduction is available to them. And this is over and above that 2 lakh rupees. Over and above that 2 lakh rupees, because if the assessee is paying interest for their home loan, and if they are first time home buyer, it means that they must be occupying their house for self-occupied purpose only, right? So if I purchase a house for the very first time, probably practically 99.99%, I'll be staying in that house, right? This is for me. This is my first house. So in that case, if it is self-occupied, assessee can claim in 24B. But if in case the assessee is paying more interest, more than 2 lakh, then assessee can come in 80EE or 80EEA. So 80EE is quite old section now. So there is very less chances that examiner will ask you question on this 80EE. Here, because there are certain conditions. First of all, the condition must be the loan must be sanctioned during previous year 16-17. See, it is now 7-8 years now. So this loan should be sanctioned between 16-17. Then you can claim deduction in 80EE. And some other condition is there that this house should not be a very big house. It should not be of value of very high value. The maximum house value should be not more than 50 lakh. Second thing, the loan amount which you have taken should not be more than 35 lakh. So first is, it will hardly come. This is one of the least important section for examination purpose. So the loan should be sanctioned during previous year 16-17. So if loan was sanctioned in 16-17, it might happen that some person might taken a loan in this particular year, and still in this previous year 23-24, he's paying EMI. So whatever the interest which he's paying, they can claim deduction over here. But this is over and above 2 lakh, right? Because up to 2 lakh, that person can claim deduction under 24B. This is over and above that. So assessee must not be the owner of any other house. It means that person is a first time buyer. What is the condition? The value of the house should not be more than 50. The loan amount, the loan which we have taken from the bank or financial institution, it should not be more than 35 lakh. Loan must be sanctioned during this date. And this is over and above 24B. But the maximum deduction which we can claim is 50,000 over there, right? So if we have taken a loan from NBFC, it will be allowed. Non-banking financial companies, no. In 80EE, 80EA, NBFC is not covered. If we have taken a loan from financial institution, from banks, etc., then it is allowed. But from NBFC, it is not allowed. Why I am emphasizing on this point? But because in electric vehicle, in 80EEB, you can take a loan from NBFC also. So in 80EEB, it is written that you can take a loan from NBFC also. But here, to claim a deduction in these two sections, the loan should not be taken from NBFC. Right. So if you have purchased, the loan was sanctioned during this previous year. But if the loan is sanctioned after this year, then the assessee can come in under section 80EEA. But here, the point is, the loan must be sanctioned during this period. From 1st April 2019 till 31st March 2022. This is the date. So if the assessee has, these two sections are not because when was these sections introduced, they were important in that particular year. So for this 2024 examinations, these two sections are not that important, but still you should know that. So if this loan was sanctioned during this particular period from 1st April 19 till 31st March 2022, if the loan was sanctioned between this period, then you can claim deduction. And how much is the deduction is? Here it is over and above 2 lakh, because 2 lakh deduction we can claim in section 24B. And if we are paying more interest, let's say if we are paying 4 lakh rupees interest, 5 lakh rupees interest, then over and above that 2 lakh, we can come over here, but maximum it is 150. This is 150, right? And the condition over here is that the stamp duty value of the house should not be more than 45 lakh. Stamp duty value of the house is not more than 45 lakh. So if the assessee has taken a loan in this period, then he cannot come here. He can be in 80EE. If the assessee has taken a loan from this period to this period, then that person can come in 80 EEA. And what about, sir, if the assessee has taken a loan after this date, there is no deduction in any of the section, right? So if the assessee has taken a loan from 1st April 2022 and onwards, there is no such deduction right now, right? Okay, so this was 80 EEA. So please remember, in 80 EE, the maximum deduction is 50,000. In 80 EEA, the maximum deduction is 150. Here, there were two limits. One was the value of the house, 50 lakh. One is the loan amount, 35 lakh. But here, only the stamp duty value of the house should not be more than 45 lakh. Only one value is given over there. Not of the loan amount, just the stamp duty value of the house should not be more than 45 lakh. Getting it? Okay, now last section in 80E family. 80E is related to interest. So next section is 80EEB. 80EEB is related to interest on electric vehicle. Electric vehicle. If you have purchased a two-wheeler, three-wheeler or four-wheeler, then you can claim a deduction. If the loan is taken from financial institution, including NBFCs also. NBFCs I have not written over here. Please write NBFC also. Let me write it down. Or NBFCs also, right? And obviously this is available only in optional scheme, not for new scheme. And the maximum deduction, the conditions are that this section is only available for individual, not for partnership firm, not for company. Okay, it is not for even HUF. So if the loan is sanctioned between 1/4/19 to 31st March 23, the loan should be sanctioned between these dates, 1st April 2019 to 31st March 23, then you can claim deduction. Here I have written it. From any financial institutions, bank or NBFC, then deduction is allowed. How much? 1,50,000. So even if you have purchased a personal car for yourself, let's say you have purchased a Tata Nexon e-vehicle, electric vehicle, then you can claim a deduction. Whatever the interest which you are paying, even if it is your personal vehicle, then you can claim 150. But if it is your business vehicle, if you have taken it for business purpose, then you can you claim deduction under this section? The answer is yes, you can claim. But if this interest is already be claimed under any other provision, then you cannot claim double deduction. Why I'm saying this? Let's say, tell me, if you purchase any business asset, and you take a loan and you are paying interest, that becomes your business expense, right? And for interest, we understand that we have a section in PGBP, section 36. We have already discussed other deductions, right? So if you have taken a loan for business purpose, if you are purchasing any business asset, then there is already a section under section 36. Then you cannot claim double deduction. Then in that case, if you are already claiming a deduction under section 36, you cannot claim over here. And in 36, whatever the interest you are paying, you can get the deduction, right? There is no limit in that case. So if the assessee is claiming deduction under section 36, then he will not come in 80 EEB, correct? So for personal vehicles, you can come in this section, but for business vehicle, generally the assessee will not come in this section, because here also there is a limit of 150. So he will claim deduction in section 36. So if that person is claiming under section 36, that person cannot come in this section now. So this point is written over here. If deduction is allowed under this section, then such interest deduction is not allowed under any other provision. See, so it is better to advise the assessee, please go in 36 here, boss, because there is no deduction also. And your business expenses, you can claim deduction under that particular section. Got it? Okay, guys, I think we'll keep it over here. So this, you can keep it as the first part of your deduction, because I would not like to rush over here, because I would like to give some time to each and every particular section. That is the reason I'm stopping over here. And we'll continue tomorrow. We'll continue at 10 a.m. tomorrow, and we'll finish this the remaining sections tomorrow, right? So please let me know how you are finding this lecture. Let me know. Okay. So please tell me how you are finding this lecture, and this is especially for the English speaking students, non-Hindi students. And I would also request you to please share this video with your friends. Till then, thank you so much, and we will continue this tomorrow at 10 a.m. Bye.